and welcome to the US Market Breadth Update, where I look through the major US charts and market breadth indicators each week in order to get an idea of where the market is going next. I've been doing this weekly update of the market breadth on my website, stageanalysis.net, since 2013, but I thought with the launch of my YouTube channel last week, I should start doing the regular update as a video each week too, so I can talk through the charts in more detail. However, I know that some people are short for time, and so I'll start the video with a quick run through of all the charts, skipping to the next one every 5 seconds or so, which should take about 3 minutes, as there are around 40 charts to look through. Once I've cycled through all the charts, I'll then go through some in more detail for people that have a bit more time to watch. Okay, let's begin. Okay, that's the first run through, just so for the people that can only watch for a short amount of time. So next, let's start having a look through them in more detail. So first up, we've got the index charts. So we have the S&P 500 as the first chart, which as you can see, still strongly rising above its 10-week moving average here and rising 30-week MA. It's quite extended from the 30-week MA at this point. Not quite to the levels that we saw at the end of 2017, but it is quite extended nonetheless, with a huge run since October lows. So next, this is the NYSE Composite Index, which is the broad index of the NYSE, which, as you can see, similar strong run, but is nowhere near in the same performance. You see the relative performance versus the S&P 500. It has underperformed for over 3 years now, maybe even longer if we went back further. Went back on the monthly. Yep, it's underperformed since literally 2010 here. So moving on to the Nasdaq Composite, which is the other half of the US market, which again was still pushing new highs here. So not much difference to report. Same with the Nasdaq 100. As you notice with the Nasdaq 100, unlike the NYSE, it's actually outperforming the S&P 500 as it's making new highs above a rising zero line. So Dow Industrials, again we've got a little bit sell off there. It's underperformed for most of 2019. Small caps have underperformed since the October breakdown in 2018, and we've only just recently broken out and it's pulling back while the other indexes have been moving higher to new highs. So this one's looking a little bit more shaky, and but it has made a stage 2A breakout recently, so it's still above that level, so still in okay shape so far. But as we said, relative performance, you want to see, for a strong bull market, you want to see the small caps outperforming. Gold, this one had a large volume week this week. It attempted a continuation breakout after 1, 2, 3, 4. It's in its 5th wave now, and it attempted to make a continuation breakout above the August-September highs here, and looks like it's been knocked back down. Let's look into the 2-hour chart. Let's see, no, don't have 2 hour for that one. Hopefully daily chart. Yeah, it's big reversal on heavy volume, which is not a great sign. So let's keep an eye on this and see how it develops. Oil had a huge reversal week. Imagine it was news related due to all the stuff that's going on with Iran, etc. But it still hasn't managed to make a stage 2 breakout yet. Although it did attempt one here, although it would have still been below its ultimate resistance here. But yeah, it still remains in stage 1. Copper, potentially argue this is making an early stage 2 breakout down here, because it's broken above a few highs and the 30-week moving average is moving higher. So it's just edging into stage 2. It's still below strong resistance from earlier in the year, and as you can see, it's been underperforming, although obviously the market does seem to tend to move higher when copper's doing well. So as you can see from the October run and the early 2019 run here. So okay, next we've got the NYSE Bullish Percent Index. So we're now into the market breadth indicators. The Bullish Percent Index is often known as the head coach. It's one of the key. It measures the amount of stocks on P&F double top breakout signals, I believe. Might be wrong. I think that's the case. It's just basically stocks on a P&F buy. So this is currently approaching. It's at 68%. So it's in strong territory currently. We've got the Nasdaq Bullish Percent Index, similar to the NYSE. Both are in their mid-60s. So they're both in strong bull market territory currently. Not near their oversold levels as yet. Okay, this is the NYSE percentage of stocks above their moving averages. So we look at, I presented it like this. I do normally look at individual charts quite a lot of the time, but I prefer to see these as a whole. So you have the 200-day moving average, the 150-day, and the 50-day moving average. So you've got short, medium, and long term all in one. And up the side here, we've got the percentages. So, for example, the percentage of stocks above their 200-day moving average is currently at 71.09%, whereas the 150-day is at 73.38%. You can see the 50-day is at 71% basically, but it has been rolling over the last few weeks. So like when you look at these together as a whole, you can see like the best buying points are always once all of them are flushed down to the lower level below 30%, and then all three make a move back above that 30% level and whatever the recent swing high was. So as you can see clearly earlier in the year, like the 50-day always moves first, so that moved out above that swing high in the late December, and then 150-day moved out above its swing high in the 30% level in early January, and the 200-day moved out in mid to late January. So obviously that would give a clear signal on this indicator that that's a signal to buy after we've had a strong flush to the lower levels. So this is one I rely on quite a lot for market timing, so I recommend that one highly. Nasdaq, this is the same version for the Nasdaq market. So the combined, obviously the market is made up of the NYSE and the Nasdaq, like that's the majority of the stocks in the US market. So same thing as we saw, best time to buy is exactly the same when it moves out of the lower range above the 30% level and whatever the recent swing high was. So again, the Nasdaq was a bit slower than the NYSE, it broke out a bit later, but you would have nonetheless got signals in January time. Okay. Same for the S&P 500, same for the Nasdaq 100, same for the Dow. And this is the small caps. So the small caps one is a little bit different because I don't have the data for the 150-day. So I've made this one with, I only have data for more short term. So this one uses the 20-day, 50-day and the 200-day. So it still gives a good general picture. You just miss out the 150-day data. So as you can see, it's not doing quite so well in the short term. It's pulling back 42.5% level at the moment. So obviously short-term buy points, again, same as moving out of the lower ranges. It's always best to buy on a move out, in my opinion. Okay, this is the NYSE cumulative advanced decline line, and I use a 50-day moving average on it. It's just an arbitrary moving average, but it seems to help with timing, etc. So this is the same chart, but the advanced decline volume instead, so which is a little bit more volatile. But again, let's go to the Nasdaq. It's the Nasdaq advanced decline line, which is cumulative advanced decline line. It's obviously the same setup, and then the Nasdaq advanced decline volume. So again, I use a combination of all of these in terms of when thinking about the signal. So don't just use a single chart. So we would look at all four of the cumulative advanced decline lines as one, and if all four are telling you the same thing, then obviously that is giving you a stronger signal. So this is the other part of the advanced decline lines where we do the momentum indexes. So we use the 10-day oscillator and the 200-day moving average, which is what Stan Weinstein considers the momentum index. So as you can see, the 10-day moves up and down in a general range, and so best times to buy are when it's obviously moving off the lows or when it pulls back around its zero line and then starts to move up again. So the 200-day moving average version, which the momentum index is a much more long-term measure, and basically major breakdowns or breaks below the zero line are when it becomes more interesting, but for the most part it will be relatively ignored. This is the same version for the Nasdaq. This is the NYSE McLennan oscillator, which again is an advanced decline line indicator, and basically it works by, it's to do with the 19 exponential moving average and the 39 exponential moving average. I can't remember the exact calculation of how to work, but basically top version here, the oscillator is moves similarly to the advanced decline line one I just showed you, where it basically moves up and down the range. and has a zero line, whereas the summation index is the 2 moving averages, the 19-day exponential moving average and the 39-day exponential moving average. It's the difference between the two, basically. I think the zero line is the 39-day exponential moving average, and the top line is the 19-day. So you get differences between. It shows you momentum. So the NYSE, which is a Nasdaq version of the McClellan oscillator, same thing with the summation index. This is what we were just looking at, but slightly faster. So these are exponential moving averages of the NYSE advanced decline line, and basically the McClellan oscillator that we were looking at before uses a 19 and a 39, whereas I like to use a slightly faster 10 and 30 day EMA for these ones, and because the signals are a little bit more frequent. And so as you can see, like, it gives the crossovers are our signal points, and you get some chop, but the idea is that obviously it's not just a single chart you're going to be looking at. Again, you're going to be looking at the volume, the advanced decline volume. You're going to be looking at the Nasdaq advanced decline and the Nasdaq advanced decline volume. So again, like earlier, we take all of these together as one. So one signal alone is not enough. So obviously when all four have a signal, then it's more important. So for example, early in January here, we had a signal on the advanced decline, on the NYSE advanced decline one. We had a signal on the advanced decline volume. We had a signal on the Nasdaq advanced decline, and we had a signal on the advanced decline volume. So you can see these have a lot more signals on the other ones, but the NYSE one is the one I focus on a lot more. And so this June signal here, fairly sure we had some earlier signals in earlier in May in some of these, in these other ones, yeah, and all the other ones. So that signal was again shown in all. So you might have got chopped out here, but then it got all four of them, got you back in again straight away in June. And like, although the other signal to get out, the NYSE one hasn't signaled since then, so this would have stayed on a buy signal since June. Okay. Next we have the NYSE new 52-week highs versus the 52-week lows. So the red is the 52-week lows, and the grey area is the 52-week highs. So fairly self-explanatory. Basically we have a horizontal line set at 100, which sort of the new lows, when they poke above that level, start to get a bit more interesting. So again, we do a combination of multiple markets, so it's always the NYSE and the Nasdaq combined. So you don't just use one chart for signals, you use multiple charts. So again, both of these at the moment are looking, let's give that one. Both of these at the moment are hitting new highs. So yeah, strong. This is the same chart, but as a cumulative version instead. So again, I use a 50-day moving average just to have a moving average. It's fairly arbitrary again, but it gives you a general picture and obviously reasonably good signals of when to get in and out. So let's have a quick gander here. So it broke below its 50-day moving average in early October 2018, and then it moved back in late February. So, and since then it's stayed above. So the two major signals on this to get out in early October 2018 and get back in late February 2019 would have held you fairly good this year. I have in the background I have the new high, new lows with a zero line, so you can see the cumulative. It's not just a cumulative; it's just a different way of looking at it, but it gives you a good idea. So you can see, obviously, not all these breakdowns are as strong, because obviously when you're strongly rising, then it's less relevant. But obviously, once the moving average has turned down and it moves below, has a crossover below, then these moves become much more relevant. So you can see these pullbacks here in the middle of the year were all above a rising 50-day moving average, so they're less important. We would take more note if the price had moved below the 50-day moving average. Okay, this is another way of looking at the same chart again. This is the momentum indexes of the new high, new lows. Again, the 200-day momentum index, and this one uses got a 50-day momentum index here. So again, fairly useful for like signals, but not brilliant, but they give you a good idea of when to be roughly in and out. And this is again, this is the 5-day total of the new highs versus the new lows. So just a simple 5-day cumulative approach, which gives a smoother chart. But you can see where obviously it remains very strong currently. Okay, moving on. Let's go to. So these are my custom charts. I do a cumulative point and figure breakouts minus breakdowns in the US market each day on my website on stageanalysis.net, and basically this is similar. It works similarly to the advanced decline line and new high, new lows cumulative lines. They again give signals. I've got a 20-day moving average and a 50-day moving average on it, so I use the 20-day moving average on it for signals. So it gets you, again, would have gave strong warning signals to get out in the October 2018, and got you back in again in January this year. So we had some whipsawing low in the middle of the year, so there was multiple ins and outs. So again, this is same as the others, that you don't use a chart in isolation. You use all of the whole point is to use a weight of evidence approach, where we look at all of the charts as one and then decide on the major signal. So obviously during this time of chop, if other charts like the advanced decline line hadn't had signals, or new highs, new lines hadn't had signals, but this has a signal, then it just indicates to be more cautious. But it doesn't mean, so you would have maybe tightened stops or like got rid of weaker stocks in your portfolio. Just sensible money management techniques. So let's go through these. So this is the P&F breakouts minus breakdowns in the US market. This is again the same chart as we just looked at, but the other one was the cumulative version. This is just the straight up and down version. We then got the distance above its 20-day moving average. I use this for a little bit of signals. The moves above the moving average there give some signals of when to be more cautious or more aggressive. This is the momentum index. This is the 10-day MA. Works the same as the advanced decline line momentum index. And this is the 20-day version, the 50-day version, and the 200-day version. So as you can see, again, moves above below the zero line are good signals on the longer term version that I like to look at, and the oscillators give you when you're extended or when the market, when it's got extremely bearish, to look to be more aggressive again. Okay, I think that's the end. Okay, that's the end. So if you like this and want to subscribe, then click the button in the bottom corner down here somewhere. And if you want to see more charts, I do daily stock watch list each day on stageanalysis.net, and I'm going to be updating my videos weekly on here, and I'm going to be doing watch list stocks as well. So yeah, subscribe, and I'll see you next time.